Hi, I'm Colin Ward, an Associate Professor of Finance at the Alberta School of Business at the University of Alberta. Part of my work studies currencies, and I'm excited to tell you a little bit about my research today. So part of my work on exchange rates is in a bigger area called international finance. And common questions in this literature inquire about drivers of exchange rates. So countries that typically export a lot, think about Germany with the Deutschmark pre-euro, typically had strong currencies. So strong exporters typically are associated with strong currencies. Riskier currencies, and I'll define what risk means shortly, tend to have lower values. And then drivers of exchange rates are going to be these things called shocks. So shocks are basically unexpected events. You can think about the involvement of Trump's tariffs or say COVID-19 as examples of adverse global shocks. One common theme in my literature shows that riskier countries tend to depreciate and safe countries tend to appreciate during adverse global shocks. So in my work with co-authors Raman Hassan, Eric Lualish, and Alex Pecora, we study how trade influences currency risk. So red circles are going to indicate GDP, and then the blue lines connect every node in the network, and they're going to measure trade costs. These are basically impediments to trade. Not only do they reflect tariffs, but they reflect other things like, say, differences in shipping regulations, indirect costs. And so it turns out in the network what you see is that countries that trade more are going to be closer together. If you look into the core of the network, into the center of it, you'll see core countries are going to be like the US, the Euro area, and China and Japan. Peripheral countries are going to be Russia, say New Zealand, Australia, Colombia. And so in our paper we show that peripheral countries have a great deal of currency risk. So more currency risk means that these currencies tend to depreciate when an adverse global shock occurs. Countries in the core, on the other hand, tend to have currencies that appreciate, so gain in value when an adverse global shock occurs. So you can imagine sort of flows go from the periphery into the core when there's bad events, adverse global shocks happening. Finance professionals refer to this shift as, say, a flight to safety. What we show in our paper is trade deals influence currency risk. So what that basically means is that if two countries say sign a trade agreement and trade boosts between the two countries, what happens is that the amount of currency risk also falls. And so that means more trade reduces currency risk. And so what we find in our paper is that countries on the periphery are the ones that benefit most from trade agreements. So if the US signed a trade agreement with New Zealand, that would have a bigger effect on reducing New Zealand's currency risk vis-a-vis the US than, say, if the US signed a trade agreement with the UK. The UK is already part of the core. You can imagine that the trade agreement sort of pulls in the peripheral countries into the core, and once you're in the core, you become a safer currency. Why does this matter? First, our paper shows that trade deals are not just about trade. In particular, there's an important component of trade which reduces currency risk between two countries. And then lower currency risk means it's cheaper for corporations to invest in that foreign country. So there's sort of two parts to risk in terms of foreign direct investment. One is going to be the risk of the foreign country itself of investing in that, but there's also this currency component. And so by lowering currency risk, you can actually lower the effective net cost of FDI, so you'll see more development. A famous question in the economics literature was posed by Robert Lucas. He asked, why does capital not flow to emerging economies? And so we think our work on trade and reducing currency risk highlights the importance of this question that we ask in this paper. Hope you learned something. Thanks for listening.